Hello, hello, hello. Welcome, welcome, everyone. We are so glad you are here today. We just have an amazing speaker, and I will announce her in a minute. I'm Peggy Beauregard, and what our company does is we match the equity partner with different kinds of sponsors on whatever their commercial asset classes are across the United States. So we're very excited to be doing that, to have people become really great portfolio holders and be able to have more choice in their life. Today, I'm going to read this I need my glasses to do that. I read this quote from Jim Rohn. A lot of you may know or may not know Jim. He was just a brilliant, brilliant man. And I thought this was befitting to have Tish on today. You must constantly ask yourself these questions. Who am I around? What are they doing to me? What have they got me reading? What have they got me saying? Where do they have me going? What do they have me thinking? And most important, what do they have me becoming? Then ask yourself the big question, is that okay? Your life does not get better by chance. It gets better by change. Jim Rohn. So thank you very much, Tish, for being here today. We are really thrilled to have you. And I'm going to give a little bit about your background. So Tish Burnham is paving the way for future generations of female wealth advisors. As a partner and COO of the Zandbergen Group, Tish specializes in true wealth strategies, wealth management, asset transfer strategies for high net worth individuals and multi-generational families, and full service strategy planning for business owners. From those seeking an entrepreneurial framework to those exploring an exit plan. So Letitia has it all covered. She has been recognized as the Orange County 5-star wealth manager for 7 consecutive years. She has earned the accredited investment fiduciary designation, certified exit planning advisor designation, and holds a Series 66 securities registration, as well as long-term insurance and life insurance licenses. Additionally, Tish's expertise has been featured by Forbes Business Council, and she's part of the Brea Chamber of Commerce Women in Leadership Council, advocating for women overcoming barriers and advancing their careers. She was also recognized as a Woman of Achievement by Senator Bob Archuleta's office for her outstanding contributions to the community. What a lovely, lovely person you are. We are so happy to have you in our community. And Tish, please take it away and tell us all about what it is for people who want to be, who are and who want to be and need wealth managers.
Thank you so much, Peggy, for having me on the show. I'm so excited to be here. It's such an honor. I met you at the Family Office Club in San Francisco, and you and I clicked immediately. There was, as you know, not a lot of women in that room, but the ones that are there were strong and fierce, and I loved that you and I connected. And you actually, I don't know if many people know, you wrote a book, and you wrote this beautiful book and dedicated it to me. And I just thought that was so lovely. And the things that we talked about, that what you do for your clients and your ecosystem is so similar to the things that I do for my clients and my ecosystem. And so we decided to have this conversation today and talk about something a little bit more general. So, I have the opportunity to work with all sorts of people in their wealth and different places they are in their life and their journeys. And so we talked about doing investing 101. And so this is not necessarily something that I would sit down in a client meeting and share about today, but I wanted to kind of break down a little bit about just generating wealth in your life and kind of break it down to some of the basics and talk about what some of the basics are and how to create wealth and different options. And so something that you're going to realize from me a little bit different, and Peggy, you and I shared this, is we actually do look at real estate as part of people's overall portfolio, and we don't poo-poo it. And sometimes you find wealth advisors like myself that may look at that and say, we just want to manage the money, and we don't want to really share with people that are just building wealth in general through maybe just real estate. So I wanted to dive into some of the different options and what that might look like, and really maybe even talk about some basic concepts. So again, Peggy, if you have me on this show again, I would love to be able to elaborate a little bit more, and we can kind of go down additional paths. So thank you again for having me. I wanted to start a little bit about my background. I think that might be helpful, just knowing a little bit about who I am, and then it kind of understands how I landed here. And so something to know about is my mom's side of the family, and they're Smallwoods. They were farmers. They grew up in Washington State, and entrepreneurs, really, small business owners, and they were real estate collectors. So they had real estate from all over and they had many businesses that they owned over the years, and you know, after the fact, you would look at them as serial entrepreneurs. And I learned so many basic things without even knowing it about being an entrepreneur, being a business owner, owning real estate, having multiple family members dealing with real estate. As people know, more people getting involved, it could get people can get angry with one another and get jealousy. And when money gets involved, sometimes it gets complicated and people don't always talk about money. And when that kind of stuff happens. So talking about the conversations today, I'm going to talk about big picture, but later on we can talk about a little bit deeper in regards to that. And then you have my dad's side of the family. My dad's side of the family is 12 generations, 13 actually now, of doctors. And so my grandfather was a dentist. And so they were business owners back in the day. You would own your own practice. And so that was their philosophy of, like, you know, the very one path. And so most of their wealth actually was in the stock market and investing, and not real estate. So and again, they didn't really talk about it, but I'm just sharing because I am this grandchild of these two different ways of thinking about building wealth. So what I'm going to talk about in general, I'm going to just talk about some of the most basic things. And so I want to talk about, you know, what are 3 types of ways that you can build income, and then I'm going to kind of continue to elaborate on different pieces. So there's earned income is one. Earned income could be that you're working for somebody and you're getting a W-2 paycheck. Earned income could be you're a business owner and you're collecting receivables, and at the end of the day, after paying all of your expenses, you have this net number, and then you have income from your company. And then another way of income, so income number 2, is passive income. And you are probably more familiar when I'm saying this. If passive income could come in the form of rents and income from real estate. It's very common when you say that passive income. So it's not something that you're working to make a paycheck from, but it's passive income from an investment, more like a real estate. And then the third one that I'm going to talk about is portfolio income. And in this scenario, I'm referring to this as assets. And so think of it as securities and investments. So I'm going to take it a little bit, one more step, and I'm going to break that down. So when I use the word assets, I'm thinking of things specifically that's like grounded in the ground. So when you're thinking of that, think of like if you own your home, that's an asset. You own your car, that's an asset. Say you are an owner of a building in a commercial park, that's an asset. And then when you're looking at your on the security side of assets, you can have your stocks and your bonds, right? Those are also assets. So these assets that you own, your company, if you own your company and you own it outright, that's also an asset. And then there's your liabilities. So you also think of it as like your debts, right? So if you're looking at your liabilities, think of like a mortgage that you own or a loan payable to someone, that's a debt. And so a lot of times in a balance sheet, we're looking at assets, you're looking at then subtracting the liabilities that you have outstanding, and that creates your net worth. So very, very basic information that I'm talking about, but a lot of times this is so important to understand the fundamentals. I can't tell you how many times even CEOs come to me and say, hey, Tish, can you help explain my balance sheet, help explain my profit and loss statement? And so I want to start super basic because at the end of the day, if you understand what you're investing in and how you're reading these investments, you're a more educated investor that understands the decisions that you're making and that you understand the risks that you're taking for the opportunity going forward. So that's really important when we're looking at that. And so, you know, a lot of times when we're talking about money and growing money, people are saying, you know, one thing I took out from when I was a kid from my grandparents was have your money work for you. Don't work for your money. And so that is something that is ingrained in me all the time. And so that one little statement can create financial freedom. And that definition of financial freedom is totally different for everyone on this call or everyone who's listening going forward. Completely different. So, as a wealth advisor, what I do is I work with my clients, and it's a very holistic plan, and saying, what's your goals? What's your dreams? What's your desires? And then we create this roadmap. And so this roadmap looks very different to everyone that I talk to. And so everyone's like, well, I just want like the statistical things, and I just need to know what I need. What's that number that I need to get? And the reality is it's totally different for everyone. So, you know, happy to have one-on-ones later and answer those questions. A lot of the things I'm going to say on this call, I want to be super clear for my compliance and knowing that I'm not giving you specific investment recommendations on this call. You guys are all unique and you'll have your own situations, but I really want to kind of break down the fundamentals when you're talking about building wealth. And that's truly what we're talking about, is building wealth. So I think of income as three legs to a chair. And so you don't need all three legs to the chair, but all three legs I have seen from many successful people over the years become financially and independently wealthy and for generations to come. So that being said, I've kind of given you the answers ahead of time, but one is, you know, potentially being a business owner, and it could potentially be maybe less expensive to start a company and run a company. So that's one way to build this income going forward. You're building and you're growing. But then when you get your nest egg, your cash, you have some money left over. Now, are you letting that money work for you? And so that's when we're talking about building it along the way. And so, for example, now you've earned this money, you've earned this income, you have this nest egg. Now, how do you invest it? So I'm going to talk about two different strategies, ideas, but it doesn't mean one way is better than the other. I'm just talking about ideas. So when I talk about the portfolio income, I'm talking about investing in the stock market. And what I mean by that is you can have someone work with you depending on where you are in your journey. And so I hear a lot of people say, hey, you know what, I might just be like a real estate person. I only invest in real estate. That's my jam. Although I'm going to tell you, diversification is critical and it's important to be able to diversify. So when I'm talking about, I'm going to switch over to passive income. So say you're investing in real estate and you've maybe purchased a building and now they're paying you rent in exchange. And so you're getting this passive income. You're kind of sleeping and money's coming in the form of rent. Okay. I'm not talking about the mortgage right now. I'm just talking about your numbers are going to need to add up to the end of the day, that we're going to use words later on like that it's positive cash flow, right? So we want to make sure that it's positive coming in. But if you have positive cash flow, money's coming in on the real estate. So some pros and cons of real estate. Real estate, a lot of times people can depreciate that asset over time. They're also getting appreciation in the value of their property. So they buy it, let's say, at $500,000. They hold it over 10 years. Later on, let's say that's $1 million, right? That's appreciation from the growth of the actual investment. And then the third thing is that income that it's spinning out and it's producing. So those are three really beautiful things that you get from real estate that we encourage and we love. And these are, again, big picture. Another thing to consider when you're talking about real estate is sometimes you need that money for the down payment, right? If you're going to go direct, there's other ways you can work with organizations and saying, I'm going to give you a piece of money and then you go invest it. And I'm going to have a fractional ownership of the whole piece. And it's a people grouping together to kind of put their money together to invest. So that's another way. If you are going to invest maybe by yourself and buy this one piece of property, you need to create some down payment. So a lot of times when you have real estate, sometimes people get the bug and they're like, I want one, and then you get another, and then you get another. I call it a bug because you just kind of see the growth over time. And what I love about that is it grows over time, but there's some downside. The downside is your asset is stuck in the ground. So what does that mean? That means that like, I can't just go take some dirt and go use that to like buy me some clothes and get some food. And like, it's a whole process if you were going to sell it, right? And liquidate your assets and transition that money. So there's some pros and cons to consider, right? Of, hey, what does that look like? With regards to liquidity, right? So that's a question we always factor in. And then we also factor in like, how am I going to get this down payment? So we all know that there's lending, there's options out there depending on what that looks like, but sometimes you need to save that money to get that lending, to get the money for the down payment. And so that way you kind of have a start, right, in the whole process. So I'm sharing some very basic things, but sometimes people are like, well, how do I even get started? I see people doing it. Sounds so great, but when you get going, it's a lot of work. And so that's kind of one piece of it. And then I'm going to switch back over to portfolio investment. So some of the pros and cons of portfolio investing, a lot of times people don't maybe understand it. And I'm going to say finance in general, all the things that I'm talking about, there's all of this language and vocabulary that's confusing. And sometimes it just needs to be broken down to be a little bit more simpler. Like people are buying they say equity and fixed income, but equity just means stock. And that really means you're buying ownership in the actual company. And your goal for that is for that company to go up in value. And the value makes either the price per share go up, or it also makes, could give you some type of dividend, which is also a form of they're giving you as the owner profits from they're sharing the profits with you. And they give that in the form of a dividend. And then they also have fixed income. So fixed income is think of it as like a debt obligation. You're loaning company money in exchange for a payment over time. And so it's also this passive income for people as well. And I'm going to say that depending on, you don't have to play on the stock side and only play on the real estate side. I guess my question to the audience is think about opening your mindset of thinking about diversification and having all three pieces, maybe some type of ownership or how you're building your wealth on income basis, maybe some type of real estate, and then also maybe some type of portfolio. And something a lot of times people do, if they're like, hey, Tish, I'm just growing this money while I save it to buy the next investment, there's fantastic tools that people could use. And again, this isn't an advice. I am going to say is I recently wrote an article in Forbes, and it talks about some specific tools you can use that we call low risk in our world, that you are able to kind of have access to right away, but your money's actually working for you instead of being maybe in a bank account earning nothing. You might be able to take advantage of something. One example is like a treasury bill. And a treasury bill is something that, depending on the time that you choose, so it's basically think of it as like a loan or a note, right? And in exchange for a payment of income. And right now we're seeing fantastic rates for treasury bills. People are loving that. And it has tax advantages on the state side. And then also it helps offset your overall taxes and your overall goals. So couple solutions, couple options. I would suggest I can send out the link or send you guys the link for my article in Forbes to kind of break down several more specific options that you can try, that you can think about. I'm just wanting to make sure I'm respecting the time, that I'm only kind of just throwing out one example. So in this one, I'm talking about something like treasury.
Yeah, so we have several questions. So
okay, yeah. So do you want me to stop, or you want to ask questions now, or do you want me to kind of go for a couple more minutes and then you questions?
Yeah, go ahead, do that. Couple more minutes.
Okay, perfect. Okay, so I talked about investing, I talked about real estate, and I talked about building income. So these are all income plays. People talk about income all the time, but they don't actually tell you how to build it and put it together. I also want to just take one moment to talk about expenses, because expenses are critical to understand. Now, there's good debt and there's not so good debt. And sometimes it's good to take loans and leverage. But I just want to throw out 3 words. And a lot of the things I'm using now are basic concepts, but it's good just to be able to understand. So when it comes to expenses, think of like essential expenses, optional expenses, and unnecessary expenses, right? So unnecessary might just be in life, like maybe I want these beautiful new shoes, right? That may be unnecessary. I'm just talking about stuff right now. Optional is, I like to have it, but I don't have to have it kind of questions. And then essential is like, I need to eat, right? I need to put food on the table. I need to be able to make sure I have some groceries at home and taking care of our lifestyle and things that are the most important. So I say that in a really general context, because when you're looking at people's lifestyle, if you really want to reach your big picture goals, sometimes you have to say no to these like unnecessary expenses, because maybe you save a little bit more today and invest in your future. And I'm not even sharing yet about compounding interest and growth over time and creating, generational wealth, but little pieces that you can start today makes a huge difference in the future. So, in general, just kind of want to make sure I'm talking about big things overall. So number one, we're just talking about income, right? What are different ways to build income, ways to generate wealth, different tools. So we talked about investing in like maybe the stock market in different variations, talked about real estate, big picture. Again, there's more categories in all of those, but keeping it super simple. One more thing I want to talk about is risk and reward. So again, it depends on your risk. This is why I love to have diversification, because you need to understand how comfortable you are with risk. If you want to make money right away and get rich quick, sure, you can put all of your eggs in one basket and hope that that one thing is going to do really well. But do you want all of your risk in one company, one property, and maybe it's one company, one stock, and it just sinks? Okay, that sucks. It's gone. Like Enron, right? What if you put all your investments in one company and then it just disappears, right? That's a stock that's like, hey, I have a hot opportunity. Let's jump into that. Then that could be really problematic. Or let's say you're like, I have this amazing real estate I love, and then all of a sudden there's a tornado in that area and it takes down that property. Okay, great. You probably have insurance, but we're not talking about the lag time of like rebuilding and the lag time of getting, now you've misplaced like maybe your renters, and then now you've offset your income and you still have your mortgages that are due. Are you feeling this pressure of like, oh man, I put all my money in one basket? So we're really big fans of diversification and you can start small and build over time. And there's different vehicles that you can use in all of these different types of assets, like your investment in real estate or business, that help you maybe offset some taxes. So maybe it reduces your taxes, and then maybe you're putting money towards your investment. So there's lots of amazing strategies, and we can always kind of dump into ideas of strategies maybe in another call. But so I talked about the risk, right? So understanding the risk of what you're investing in, understanding the overall risk of that investment, how that company is doing, how the performance is, what's their track record, what are people talking about in the economy? Are they projecting to hit their numbers, right? Is the real estate numbers, when you're looking at those, are they fully rented? Do people want to be in that area? Is the actual investment in something that you see that's going to continue to grow over time? These are the questions you really want to be asking fundamentally when you're looking at any deal, right? Is it positive cash flow? Is it enough for me to offset? Am I making enough money on the investment to offset my loan that I'm getting? So these are some of the questions you want to be able to ask, and lean into your team if you don't know. And it's never a stupid question. I always say that, like you're educating yourself, right? You're learning, you're growing. And so we talked about diversification. I didn't talk about dollar cost averaging, but that's a beautiful thing about investing, right? Over a period of time. You could do that in investments, in real estate, and in your portfolio. And then also we talk about things called like buy and hold, or you actively managing things. And that could be on both sides. So those are great ideas as you're kind of investing big picture. And the last thing that I'm going to kind of talk about.
We need to move on to Q&A.
So one last thing, and then we'll do it, is know what your goals are. Start with your goals in mind, and then come up with your plan of attack, because that will kind of solve all of your questions along the way. So anyway, that's the basics. So I'd love to go into the questions and answers and kind of dive in. Peggy, if you want to tell me what our questions are, we can go from there.
Well, people will put up their hands for that. And me, I've always got questions, but I know we've got a few people on here who were coming on with questions
Okay.
like that. So one of the things I was a little not clear on, because we always talk about portfolio, but you're talking about portfolio in a different way.
Mm-hmm.
Look at portfolio as everything, putting many into the many, shall we say. So your portfolio obviously has more than one thing in it, and that's what you're living off of when you get to that point. But you're saying it was like something different.
In this scenario, so you're right. Your portfolio is your total, all of your assets. But I think the difference of what you're saying, Peggy, just to clarify, is when we look at portfolio, we look at more of the liquid numbers and the liquid growth. So more of like the investment portion. And then I look at your net worth to include all of the liquid and illiquid. And when I use illiquid, I'm referencing real estate. So I separate those, but I use net worth. It's probably just a combination of how we're defining it, but similar.
Okay, that's great. No, I got that. And then when you were talking about appreciation, you're buying a property for 500,000. It's always based off, well, when we talk about properties, we're always talking about commercial, right?
Yeah.
Because
Yeah.
commercial is always based off of the net operating income and how that would appraise off of the net, not off of the gross. And that's how you come up with what the real value of it is. So it's not like a single family home. They don't appraise the same. And you've also got all those tax deductions and doing a cost seg and all of that. So almost everybody here is invested in real estate in one way or another. Some of these people here are syndicators, and there's just all kinds of portfolios that they own already, which is really cool. So
Yeah.
that. And then I know Seema had some questions, and I think Jonna has a couple questions also. um, So the risk. Oh, when you brought up the risk, I just wanted to add to this. Now,
Okay.
one of the things that people don't think about is because they want to be in one asset class. Again, I'm only talking real estate because that's all we deal in. Is if all you did was invest in office, you'd be in a little bit of a trouble right now. So it's what you talked about with diversification is super, super important. And one of the things that we do is we educate all of our investors to diversify. You don't know what's going to happen. Like, look at what's happening in multifamily right now with all these people that didn't put their deals together properly, and lots of investors have lost their money. So if you were in office and multifamily, you'd be in a little bit of trouble. But if you actually diversified into some self-storage and some manufacturing, industrial, and some of the other asset class, you'd be in a pretty good position because they're all still doing really well. Like,
Precisely. Precisely. Exactly. It's the same thing. And even when you go to diversification, I also look at your geography as well. So
mm,
there's multiple layers of that if we're talking about just the real estate side. It's where are you located, right? Not just the type of investment as well.
thank you very much.
Yeah.
Really appreciate that. Did anyone have any other questions? Yes, Seema, you have a question? Well, maybe not. She got lost again. Oh, yes. Jana.
One is a question. Tish, you had mentioned the fundamentals of building wealth, the three-legged stool, and I wrote down, I might have missed something or got a, an item in a category mixed up, but you said business ownership, investments, and
Real estate.
okay, well, those are investments.
Yeah.
So, and then And I think somewhere in there, you know, these aren't clear categories, but when they did the intro, it said that you were licensed in life insurance, and when we talk about diversification, these things work together to offset each other, right? And can you talk a little bit about these interactions? And I mean, we even do some things where we're using income streams to fund life insurance policies to fund investments and things like that. But can you talk about, and maybe for this call, we'll talk more about how that can help mitigate the risk of your overall portfolio by having these tools that interact with each other.
Yeah, no, that's a great point. So there's multiple kinds of insurance. So I'm going to keep it super generic when I'm going to answer this, just because I didn't get real detail on any of them on this one, and I don't know your specific situation. So just because of my license, and we can also talk offline, and I can be very specific. But in general, you are correct. So a lot of times people offset risk with areas of safety measures. So specifically, like you said, people can use life insurance to fund, right? So they're using income to fund life insurance, and then they can utilize that life insurance, and then that could be used in multiple ways. So potentially, like it could be an irrevocable life insurance policy that's funding that. And then that way money's getting outside of your estate, right? And then that it offsets some of your estate taxation. So again, that's when you pass away. And then when you pass away, just in general, if you have a bunch of real estate and you have properties everywhere, you could have a huge estate issue in general. And you're like, great, I'm going to pass this on to my kids. Well, after, the limitations that has been surpassed, then Uncle Sam might be with their hand out with 50%. So again, those rules and regulations change each and every year. But the answer is then you can, if you get something else that's outside of your estate that's covered, then you can use that cash at the end to pay off some of the taxes. That's one solution. Sometimes people use this to fund, and they're being able to kind of have it as a succession plan. So we'll call it like a key man insurance. You're a key man. Like the company can't work without you, right? In this example. So you are running the company. So if something were to happen to you, the company would need to get this money to be able to replace you. So you can fund that and pay for expenses through the profits, and then it's funding this life insurance policy. And so at the end of the day, you can they bring it in, and then that could be part of a transition of your estate or to family members, and how you bring someone else in. And so there's a great opportunity, if used right, for generational wealth, reducing your taxes along the way, and depending on what your goals are, you could potentially be building cash value. So all I'm saying is, in that scenario, cash value, to not get too complicated, is say you have a life insurance policy and it has a value in that's growing money over time in a permanent policy. A cash value is basically saying, it's built up over a period of time. You can take a loan from the cash value portion, is enough, making sure you have enough for the policy to keep on moving forward in force. You could pull the loan out and take a quote unquote loan. And that loan is not necessarily, if it's considered a loan, it's not taxed. And so you can take that loan and then you can buy another piece of property with that money, because it's a loan. You don't have to say, hey, I need the loan for X, Y, or Z. You don't have to have that justification. If it's owned by the company, then you kind of want to keep it in line with the company's goals and the company's objectives. And then you can use that money over time. So it's kind of beautiful, because it could be an expense that offsets income that's flowing in. And so you're paying for something, you're building growth, and then you can loan from your policy. If something happens to you, say, I'm going to use numbers again, say your policy was worth $1 million, and you took a $500,000 loan out and you passed away, and you already had that loan out, the $1 million would then only be worth 500,000. It became due, but it doesn't become a taxable event at that time. So, to protect like you and your specific situation, the ownership and how that moves around and preserving the taxable portion so it doesn't ever have to be taxed is specific, but there's ways that you can build this, grow it, and then create generational wealth and be able to have income, or like it comes as a life insurance policy. You can get this as a lump sum as tax-free. So again, a great tool if used correctly. I don't know if I answered your question. I'm kind of elaborating a little bit more, but these are some tools that people use all the time.
Yeah, you did. And then the other issue that's of a big concern for me, so I came out of corporate life. My main investing tool was a 401k. And we originally, some of that was legacy money to leave to our kids. But with the passing of the Secure Act 2.0, it has become extremely taxable to leave to our children. And so are the wealth managers developing methods to help people divest of that in without punitive taxes, trying to get it out into other investment media?
Yeah, so that's a great point that you're bringing up. So I'm going to say is, all my clients, that's something we tackle right away, because it's actually important. Even like when they're growing money over time, we talk about like, how much money do you have that is under, I'm going to call it a wrapper of, let's say, retirement, IRA or 401k money. So which means it's growing tax deferred, but when you pull that money out, you get taxed. So one strategy that people do is when after they've retired and their tax bracket is lowered, they do over a period of time, they'll do conversions over to a Roth. And so if they do it slower, they pay the taxes on that given year, but they could potentially do a Roth conversion. And then that money, you pay that tax that year of the Roth conversion, and then it starts to grow. Then it's tax-free. And then also at that point in time, from then on, you can then pass that portion off and it doesn't affect the kids on the Roth side. It's only the IRA side. So that's one idea. But the answer is, you're right. I think a lot of people don't realize what the downsides of that is. But I think before, it sounds like your situation is not maybe the everyday, but sometimes people were offsetting and were more concerned maybe about the taxes along the way and how we're systematically pulling from it. So it is very much an active decision of how much money you want to pull from an IRA. So then that way you understand your tax bracket. So I do work with accountants. I pull the accountants in too. And I say, hey, if you have your accountant, we pull them in and we look and see, okay, if you pull X amount from your IRA and you pull X amount, let's say from Social Security, and you have X amount from income, where does my tax bracket go to the next level? And we're really strategic in what that looks like. And so we lean on the tax professionals to kind of give us the green light on what that looks like, but we're also making sure we're looking at those numbers. And so maybe it could potentially be like, we're pulling a little bit more this year because the income is down, or you're borrowing from this area. So it's a tax strategy is one way, and then also transitioning money over to kids is another. And so it just really depends on, do you think that you're going to have so much money at the end of the year, or not the end of the year, at the end of your life, that now this 401k is so big, it's going to be a huge problem to the kids, because they can get it. It's just within 5 years. So, it doesn't get that same stretching, right? That they used to be able to keep that money going forever. And so, I know you guys are talking about real estate, but sometimes people use investments that are real estate, and they can use that money. And as long as they say they want to buy real estate, as long as it's 100% covered all expenses by that real estate, you can get an investment and you can purchase within that. And so that can help also stretch that out or help that transition over time. So another idea along the way. I don't know if that answered your question, but there's lots of options. And we usually look at your specific situation, and then we come up with ideas and strategies based on your specific situation to be able to come up with a game plan.
Yeah, I mean, I think, and I just wanted to bring it forefront in this discussion.
Yeah.
Is our taxes are not lower in retirement. That was something they told us that's not true. B, they changed the game and they didn't really tell people. They don't really know. And C, the data says that our children are going to inherit our money in their peak earning years, which I didn't work. And then when you said it, and then it's difficult to get it out. And in fact, you can make yourself ineligible for Medicare by rolling too much. Right. So it's really, this is a new challenge that I don't think people are keyed into, and which is why I'm here with Peggy, and real estate has offered, some of the things, and it's easier to, it's actually easier for me to my real estate investments to my children now as opposed to a stock portfolio. So I think real estate is really coming in as a better play in a portfolio than, and I'm speaking from somebody who my beginning was primarily retirement 401k Roth, right? And now I wish I would have known this information about real estate so much earlier.
Of course. Yeah, I agree. I love that solution. I'm going to default back to diversification. At the end of the day, I think having all of it is really what it could be, a beautiful mix of having a combination.
Thank you very much. So true. Seema, welcome back. Nice to see you again.
Honestly, I still cannot work Zoom. Tish, my question is, so I had a financial planner, and all he did was obviously invest in the stock market, and all I do is to avoid the stock market like the plague, because my family's, all their 401s are in the stock market. So I fired I shouldn't say mine, he was ours, but I fired him because he didn't have many different investments. So do you also not necessarily look, if I'm looking to offer, if I'm not looking for you to give me ideas, but to look over what I'm doing and understand it and try to, and, gauge it as if, is that a smart thing, or if I've lost my mind, or if you have other, obviously, if you have other things happening, then you can always suggest it. I also have a unique trust that helps meet my taxes. So, that is what I'm looking, and it is impossible to find somebody who will look at investments that are not stock market and are not real estate. Like I don't own real estate. I may have done multifamily or passive kind of thing, but I don't own anything yet. So
yeah. So I'm sorry. Go ahead. Finish.
No. So that was my question. Yeah.
Yeah. So you have great questions. And I'm going to say there's a lot of advisors out there that do different things. Traditionally at a bank, so when I'm going to say at a bank, I'm going to say maybe a Wells Fargo or a JP Morgan. I'm just throwing out names. It doesn't mean these ones specifically, but traditionally at a bank, they have a lot more regulations, and they'll have a lot less options. So they are able to invest in the traditional stock market, the New York Stock Exchange, and they can do stocks, bonds, ETFs, mutual funds, right? The individual companies, they can do that, right? And that's pretty common, and they can probably offer you like some CDs and banking options. So those are usually, and I'm going to take one more step back. I'm a portfolio manager. I create our own internal portfolio, and sometimes advisors like myself, they're called asset gatherers. They just grab money, but they don't really always know what they're investing in. I'm just gonna throw that out there. I might get some slack later, but It's very common. They invest money and they just throw it in these investments, and then they're like, hey, this is how it's doing, and then they check in. But part of us creating our own portfolio, we have more control of the levers of what we're investing in and how it's invested. And something else that we do, and I can speak to me, everyone's a little bit different, is we build out a portfolio, but we act like a multifamily office. So I'm gonna like bring that down to like generic terms. Is a lot of times we have more tools in our toolbox. So when we look at investments, we don't look at it just, hey, I want you to buy equity and I want you to buy fixed income. We look at it as 4 boxes in our how we put things together. And so we look at international equity and US combined, so equity, so companies in US and all over the world. Then we look at fixed income, so we're borrowing and loaning money in exchange for income in the US and international. And then we also look at real assets, right? So those are things in the ground, right? So if you have groups like this that are like, they're providing a syndicate offering and they, a bunch of people want to come together and buy a couple hotels together, then or a couple locations together, or they're buying, an Amazon distribution center, right? So you have access to go directly to that. And we have tools, much like what Peggy's using to say, hey, look, these are great investments. Here you go. This makes sense. And it's part of your actual portfolio. Those are called direct investments. And then we have the last one is real assets. And so those are like everything else that kind of doesn't fit into the traditional sense of all the others. So to answer your question, is you're right, but not everyone is capable of being able to invest like that. We invest more of like an institutional. So if you see like schools, when I say schools, like think of like Harvard, right? They have their own funds, but a lot of the time they have large allocations to real estate and they're buying the real estate for their funds, right? So a lot of universities do that. They're called institutional investors. They're one example of that. We kind of invest similar to that is our strategy. And depending on what you get, we can provide you is what your total net worth is. And we're bound to that based on requirements by each state and federally. So based on that, you have options of what you can get into and what that looks like. So it just depends. To answer that question, there's lots of advisors that might just pay you a service or charge a service maybe that says, hey, we'll give you, run your numbers by us, we'll take a look, we'll give you some opinion or advice and make recommendations, and then you're kind of like self-directed, we might call those. And then there's other people that are that say, hey, we'll do all of it and we'll do due diligence for you too and make sure that those investments that you're looking at are on track, and kind of being that quarterback, using a football term, but just along the way of making sure you're making great investment recommendations. And then sometimes we'll just like even leverage and say, maybe we even have like, we'll work with someone potentially that's even, that's like a private investigator that's evaluating investments. And you're like, wait, Tish, why would you do that? Because how do you know they have all of these locations in all of these places? Maybe you need someone to see if that building even exists. Right? Is there profits really there? So little things like that, just making sure that you're protected along the way. There's a lot of different, when you say that you're a wealth advisor or a financial advisor, there's a lot of different kinds and a lot of things that people do to kind of differentiate. And I think that's kind of a problem with our industry. We're not like crystal clear. You don't really know those questions. So those are the questions that you're asking. Seema is absolutely the right questions to be asking if they're capable of even helping you at the level that you're at. So sometimes,
yeah, I've been doing everything on my own. And thank God, I mean, I've lost money, but I am generating decent income. So the last 2 boxes are what I'm interested in, obviously, because I do oil and gas, ATMs, blah, 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 things like that. And you do offer alternate investments too, or you can put people together for an alternate investment. If I don't have enough money, you may have clients who may come together.
Yeah.
Okay, got it. Okay. That makes, yeah.
Okay.
Yes, thank you.
Lisa? Ms. Prince, you're up. You are muted. Oh, Norma? I'm sorry, Norma Williams.
Yeah.
Sorry, I have Lisa. I'm thinking of Lisa. Sorry, Norma.
That's okay. Tish, thanks for your comments. I wanted to find out what your fee structure is. Do you charge sort of hourly for consultation? Do you pay based on the investments that you place people in? Just overall, what's your fee structure?
Yeah, that's a great question. So we're an RIA, which is Registered Investment Advisory. So we have actually the capability of a lot of different structures. So some families, so we manage families, will manage like their entire net worth, and that might be more of a negotiated fee structure. Because if you're saying, hey, we've got things all over the place, property all over the place, we want you to manage, kind of oversee everything as a whole. That's really more of like a one-on-one. We have a conversation and we make sure that we're always competitive in nature. So there's that. If you're just saying, hey, Tish, what does that look like for assets under management? And what does that look like for portfolio? We're very competitive in nature. So in our industry, we start at a 1% and we go down from there. And it's aggregated down over time. So not over time, over dollars. So it's a whole a grid. If clients are just wanting to do like financial planning and come up with the roadmap, it really depends on how complex that is. So I always say first call is complimentary. Let's have a conversation and see what your path looks like for you. And then we go from there. But everything is very transparent. If it's a lot of work and tons of stuff and we're doing all sorts of strategies, it might be like a couple $1,000s, but then maybe it's something super simple. In my mind, I'm saying simple. We just need to kind of put the pieces together, make sure you're allocated correctly. It might, $500,000. It could be something very minimal. So it really also depends. I help a lot of business owners that are getting ready to sell their company or transition assets or wealth. So sometimes it could be very different when it looks like that. So maybe you're saying, hey, we want to do some strategy sessions. We want to bring in our attorney. We want to review our taxes, kind of look at everything as a big picture, making sure our portfolio is in order. It could be very just kind of sometimes a collaborative thought. And I act as my thing's spinning. I don't know if it's getting ready to. Okay, we're good. Sorry. I act as the quarterback. So that time we're working as a big group for you to be able to make sure everything is in order. So we kind of look at all aspects. I know I wasn't very, very specific, but I think it's more general depending on what you're looking for. But majority of the time of what we do is assets under management. And go from there. That's our main focus. And we are big advocates of having, referring out. So you're saying, hey, I don't have this piece or I don't have that piece. If you don't have someone, we can also recommend someone for you if we don't do it. So our whole goal is to really protect you and your family and their legacy. We're on the same side of the table as you and kind of guide you through that.
Great. Thank you very much. Now we're at the top of the hour. So keep that question because we'll be here afterwards, Ted. But to everybody else who's got to go, I'd like to end this meeting. So thank you very much for coming. We hope you'll come back. There are a couple more questions if you'll hang in there, Tish.
Okay.
Thank you very much.